From the University of Westminster, this is The Week Ahead with Dave Coker.
Good afternoon, guys. Welcome to The Week Ahead. This is Sunday, October 25th. My name's Dave Coker. Let's get an idea what news and significant news is going to come out in the week ahead that might drive asset prices. So, sorry about that. I'm so sorry with my animation. All right, key events. First of all, earnings. We're moving into high gear on earnings seasons in the States. We got over 170 companies reporting. We'll have to pay attention. All the big tech companies are reporting this week, and we'll see what happens with respect to their earnings and what their estimates were. We saw that Netflix had a miss last week, and it really sort of cratered the price. They took a big whack in share price. So watch out to see what happens. U.S. elections, we're really counting down, guys. It's November 4th. So we're starting to see the end state, the end game emerge. Mr. Biden seems to be, according to the mainstream polls, Mr. Biden's moving into the lead. And of course, that's going to whack the energy companies somewhat if he does get elected. The flip side is if Mr. Trump somehow manages to pull off a re-election, it'll be beneficial for energy companies. We do have to pay attention to this. Now, in terms of the elections, I'm frequently asked, because I'm American, I frequently asked for my view. Now, guys, here's my thing. We've got, in the States, we've got the free media. In other words, you don't pay anything. You get to know what they think is going to happen or what their forecasts are, predictions, things like that. And then we've got the financial press. The financial press, some of the services I get, I pay $2,000 a year for the news. The free media says it's going to be a landslide for Mr. Biden. The financial press is a little bit more suspect. They tend to note that many of these states, they're tied, or Mr. Biden's lead is well within the statistical error of confidence, statistical errors that are allowed. In other words, I was looking at one today for Georgia, 45-45, Biden and Trump respectively. 10% are undecided, and yet the media said they're using languages that is just really amazing. An overwhelming lead for Biden. Not sure about that. They're tied, and there's 10% of the people that aren't voting. Key question is, or haven't said what they would do. Undecided, they claim. And the key question is, of these 10%, how many will vote for Biden? How many will vote for Trump? We don't really know. We don't know if they are undecided, because there is a stigma associated with saying you're going to vote for Mr. Trump. Oh, and how many of the people that say they're going to vote for Mr. Biden really won't vote for Mr. Biden? They're going to vote for somebody else. It's a very fascinating question, guys. We've got the U.S. stimulus package. They're still negotiating that. They've got a last-ditch attempt to see if they'll be able to get anything. I'm not sure. I don't really have a view on that, but pay attention to it because that can drive the markets. U.S. GDP, we're going to be taking a look at this coming out, Q3 GDP. You're going to be stunned when you see what the last GDP was, and especially what you think what the forecast is for this. And also, we've got Eurozone GDP coming out, as well as an ECB meeting, a double whammy. Lots of volatility could be driven into the markets. We're taking a look here at the S&P 500. We're looking back over the past 3 months. So we're going back from July up to the present. Not a bad run, guys. If you look at this, Apple's had a stunning quarter pull past 3 months. Some 21.34%. Amazon, not really that big a deal, 4.88. Now, the relative size of these squares talks about the market cap of the company. That's why Google and Facebook are much, much smaller than Apple or Amazon. And other things, you can read this even though you can't see the details. And this comes off the wonderful FinViz website. You can read this just by looking at the colors. And the brighter the green, the bigger the performance over time. The darker the red, the brighter the red, the worse the performance over time. So you can see we've had some good performance across the board. Seems to be the majority of companies. And then we've had some that are bad and some that are really, really bad. If you go to look at the energy companies, for instance, they haven't actually done that well. So that's the S&P 500 for the past 3 months. Here we've got dividend yield. Now, guys, I've shared with you I invest only for dividends. And here what we've got is we've got green. Well, actually, I should back up. We've got some companies that they're just black. There's no dividend. Why would you own this garbage? Google, Facebook, Amazon. Why? Berkshire Hathaway is a little bit different. BRKB, we won't talk so much about that. But you can see here we've got the actual yield. And some of these companies earn, really, really low. We're talking 71 basis points for Apple. That's really pathetic. You can go in and get Coca-Cola at 3.25. You can go over and pick up some of these other companies, Philip Morris Tobacco at 6.45 on the right-hand side, about second set of tiles down. You can actually see Philip Morris 6.45%, Coca-Cola 3.25%. So that's something to think about, guys, in terms of, are you getting paid to hold your stocks? So where are you going to be putting your money? I always try to give you guys some ideas, and what I'm looking at, I'm doing a lot of looking into this over the past week and talking to my clients. I'm looking at REITs, real estate investment trusts. They're U.S. specific vehicles. See, in America, we don't have this whole buy-to-let culture you've got in the U.K. In the United States, if you get in the UK, if you get 100,000, you could buy up north where I operate 2 properties, maybe 3, generate like 15,000 a year pretty easily, right? You could actually do that, 15% return. The problem is you've got a lot of operational risk, and there's other things associated with running properties. In the US, if you get 100,000, you'd be a total idiot to put it in 1, 2, 3 properties. Why? You can buy REITs, and a real estate investment trust will give you a solid, stable return in the form of dividends. And here, what I've done is I've actually taken a look at these REITs over the past year, and I'm looking specifically at data center REITs. So I'm looking at REITs, real estate investment trusts that run data centers, because I think it's a good play on the corona crash and COVID in general and the whole work from home, work from anywhere. A lot of stuff's moving to the cloud. And you can see here on the right-hand side, we got QTS Realty in share prices alone, 30.24% over the past year. At the other extreme, we've got Global Cordwood, and he's down some 35%. So there's been a big swing there. It's not the total picture though, because to get the total picture, we got to look at total return. And you can see here, guys, we've got overall, we've got the yield, the 3-year growth in dividends, and then the payout ratio. This is adjusted funds from operations. How much of the money that they earn do they pay out? Now, I'd be careful with CoreSite Realty, a really, really interesting growth in yield, 9% over the past 3 years. Not too shabby, 3.9%, but they're paying out some 90%. So all they need is a little reduction in earnings, and that dividend's threatened. At the other extreme, you see Cone, Cypress One, 2.6%, pedestrian, right? 3.8% growth, interesting, but very safe, because they're paying out 47%, and you can see Prologis paying out some 47% and 48% respectively. So I'm tending to look at data center REITs. I'm not going to tell you which one I'm going to lean into. You put your own money down and make your own bet. Here's an interesting one, guys. Hypothetical question. What happens if only 50% of the people work? Yeah, it's really fascinating. Here I've got off the wonderful Fred site, I've got the employment population ratio. And you can see it was booming from 1980 straight up. We started to see a big intake of women into the labor force. And that's the reason for the 1980s, post-1980s surge in the employment population ratio. And then, of course, on the right-hand side, we've got the corona crash. Then we've got the recovery over the past 2 months. Now, the point is this, guys. Right now, we're running 56.6%. That is roughly the same percentage of people in the labor force that we saw going way back into the late 70s, like 74, 75. In other words, of all the people that could work, only 56.6% of the people in the United States are working. Couple nuances. First of all, I'm always a little suspicious of this number because I know people in the States who work for cash. So we're not sure how pervasive the problem is in the States, the underground economy. It does happen. So there's that to keep in mind as well, that a lot of people just don't show up in the labor force, the official statistics, but they are working because they're up to good stuff and bad stuff in the underground economy, the cash economy. What do we got going on this week? Well, once again, my animation is horrible. My apologies. Monday, October 26th, we start out at 8:30 in the morning. The Chicago Fed National Activity Index for September. Previous was 79 basis points, 0.79. Don't have a read on it. We're measuring, the Chicago Fed is measuring national business activity. So previously we did see a modest increase, and hopefully we'll see the same thing this time around. At 1000 hours, we got new home sales for September. Previous was 1,000. 311,000 new homes sold in the month of August. Forecast is to come in at 1,025,000 new homes sold. At 10:30 hours, you got Dallas Fed Manufacturing Business Index. Got to pay attention to this. Manufacturing is still a very important part of the U.S. economy. And here we see it for October. It's coming in. Previous was 13.6. At 11:30 hours, we got 3-month, 6-month T-bills and 5-year note auctions. Don't have forecasts, but again, just to help you understand what the risk-free rate of return is in the States, how low interest rates are. Previous was 10 basis points, 0.10% for the 3-month. The 6-month came in at 11.5 basis points, and the 5-year note was coming in at 27.5 basis points. Incredibly low interest rates, even though they're trending up a little bit. On Tuesday, October 27th, we start out at 08:30 hours with core durable goods orders, month on month for September. Now, what we're doing here, guys, is we're looking at durable goods. So we're looking at white goods, for instance, in your kitchen. We're looking at things that you might buy for your garage, tools, things like that. They're products, they're goods that are durable, not consumer goods that you might throw away, like say clothing, things like that. So month on month for September, prior was 0.6%. We're forecast to come in at 0.4%. Yes, the U.S. economy is starting to slow again. That's a little concerning. At 0900 hours, house price index year on year for August, prior was a stoking 6.5% increase. We don't have anything on the forecast. We do have at 0900 hours a house price index month on month for August. Again, 1% increase in 1 month. We don't have a good read on what it's going to be this time. And at 1000 hours, we got the CB Consumer Confidence Index. Prior was 101.8, forecast to come in at 102.5. That is a little controversial in my circles. We tend to think it's actually going to show the consumers are losing confidence in the economy at this point. We also see, sorry about that. On Wednesday, October 28th at 08:30 hours, we got the goods trade balance for September. Prior was 83.11 billion. In other words, we imported roughly over that 1 month period, we imported 83.11 billion more than we exported. Don't have a forecast on it. At 10:30 hours, we got crude oil inventories. Prior was a 1 million barrel buildup. Pay attention to it. We'll see exactly what we got. This does impact stock markets. In particular, if crude oil inventories are piling up, we know demand is falling. And demand's falling because business activity and consumer activity is falling. And it will show up here long before it will show up in GDP. At 1800 hours, we got Fed FOMC member Kaplan speaking. Not quite sure what's on his mind. Pay attention, because when you listen to what the FOMC members, the voting members of the Fed's Open Market Committee members, what they're saying, you get a good read on what's going on with the Fed. On Thursday, October 29th, we got 08:30 hours GDP, quarter on quarter for Q3. Prior was a 31.4% contraction in US GDP. We're now forecast to come in with a 31.9% increase. At 08:30 hours, yeah, that's huge. At 08:30 hours, you got initial jobless claims. These are people that are filing for unemployment for the first time. Prior was 787,000 people the prior week. Now we're supposed to come in at 780,000 people filing for 1 week, new claims. 08:30 hours, you got jobless claims, the 4-week average that I like to look at. And here we see the prior came in at 811,000 jobs. We're forecast to come in at 780,000 jobs. And finally, at 11:30 hours, we got 4-week, 8-week T-bills auctions and 7-year note auctions. Risk-free rates of return for these bills, 0.085. In other words, 8.5 basis points for the 4-week, 9 basis points for the 8-week, and 46.2 basis points for the 7-year. Oh, sorry about that. And then on Friday, October 30th, we start out the day with at 08:30 hours, we got corporate profits. Prior was a 10.7% contraction, no forecast. 08:30 hours, you got personal income month on month for September. Prior was 2.7% contraction, forecast a slight uptick in personal incomes. Personal spending month on month at 08:30 hours as well. Prior was a 1% increase, forecast to come in flat at 1%. We do have to pay attention to the spending. Once again, America's economy 70% of America's economy is driven by consumption, by spending. And at 0945 hours gets Chicago PMI. The Purchasing Managers Index for October. Prior was 62.4, forecast to come in at 59.3. And this is consistent with a lot of other data I've been seeing. We think the U.S. economy is weakening, and perhaps substantially as well. All right, guys, that's it for the week ahead for October 25th. Once again, have a profitable week. Take a look at the news. Try to understand what the impact of the news will be on the market as a whole and in specific sectors. Once you understand the impact in specific sectors, you can try to drive down to the company level and figure out whether you should be buying or selling companies based upon this news. Have a great week, guys. Take care.